This conference will now be recorded.
Good evening, ladies and gentlemen. This is Clueless 8 Trading Frank on Sunday, January 19th, 2020, approximately 8:33 p.m. This is our weekend strategic update webinar. Important reminder, tomorrow is Martin Luther King Day, so it is a stock market holiday. I totally forgotten about that, but that's just the way it is. So next market session will begin on Tuesday, 9:30 a.m. On that note, this session will be recorded, uploaded to the Google YouTube channel. A quick notification: Google, for some reason, some algorithms have changed within Google YouTube, and the uploads take a heck of a lot longer than what they used to be. So I go ahead and post the GoToMeeting link. All you have to do is click that, and you can hear the same video. And in the meantime, the upload goes in the background. They have a whole different things of privacy and all that stuff it has to go through. So don't ask me, all right? And so it basically gets uploaded either later in the evening, if not the next morning. In whichever case, all members can click the GoToMeeting link that I post and review the go and can go ahead and review the whole video cast. So keep that in mind. All right, so the usual reminders. We have a terrific Instagram channel where I post a few of the option trades, charts, I should say, and highly recommend and strongly suggest that all of you follow the Clueless 8 Trading. Pass the word around, get other people to follow, because those option charts are worth a lot of money. They're not in real time. Those are real trades that we did during the day or during that week, and you get a chance to see visually, which is extremely important from a standpoint as a chart trader, to look at those options charts and say, wow, this can actually do this. And those are actual trades that we have done. So please do that. Do spread the word. And of course, the Google YouTube channel is available to anybody out there with the internet connection, and they can certainly listen to these very precision, predictive analytics, as we call it, because we are talking about what might happen, not what has happened. We review that, but we're talking about what might happen, which is more important. We're not after the fact kind of guys. We like to be predictive, and at the same time, look at the charts from a risk quantification standpoint as to where we can come down, and of course where we can go. So definitely, Clueless 8 Trading on Google and Clueless 8 _ Trading on Instagram. Follow them. It's free, and make it happen. Get yourself informed. Make yourself more money. All right. On that note, full disclosure: this is purely for financial education, not for any solicitation or advice. And let us begin. So first and foremost, I'm going to state the obvious. The markets are on a major technical breakout. Generally speaking, this is known as a Elliott Wave 5, and look it up on Investopedia, which is the ultimate dictionary and Wikipedia for anything to do with finance. Investopedia. Elliott Wave theory, I'm not a master of it, but I certainly understand the basis of it. Basically, it says all major market cycles move in five cycles. And if we want to look at it from a standpoint of a long-term view, we can say that this could possibly be the seventh inning of the fifth wave, Elliott Wave 5, before we have a substantial correction. It's not the end of the bull market. We get minor corrections all the time. That's the reason why we have some hedges, because short-term we are severely overbought. But longer term, as I mentioned before, and as I've been dead right on this for a while. If you closed your eyes and bought the SPYs or the QQQs or the DIA, the Dow Jones Industrial Average Diamonds, ETFs, that type of stuff on the long side, you could basically print money. But as tactical traders, we keep an eye on the short-term money, and we certainly keep an eye on the longer-term money. But if you really think about it, that since 2019, this is 2019, if we bought into the Christmas Eve massacre on December 24, 2018, not 2019. It was a terrific December 2019. But 2018, this big red block, it looked like the markets could possibly come and retest some lower levels. And if all hell went to hell in a handbasket, we could even test this and create a massive double bottom at 2,400. And that's exactly what they were talking about. except we were showing it on our charts and we were prepared for it. However, on December 26th, the markets turned around, went up like a monster, had a nice correction on the second week, and then see you later. So one of the things that I learned a long time ago from somebody that I used to actually subscribe to, all right, this was a while ago, is to do some candle counting, all right? So let's do some, this is the monthly candle. Each candle is 1 month. So now I'm looking at the bigger picture, then we're going to zoom into the, the short-term picture, which obviously all my charts are there all the time on the real-time Twitter feed. Let's look to see the last longest streak that we have. The last longest streak that we have was the one that started on February of 2016, right there, big hammer reversal. Well, this was actually a skinny hammer reversal, which turns into a monster. So how many weeks did we actually go higher in total? 1, 2, 3, had a slight down week, but it's still technically an up week. So we go 1, 2, 3, 4, 5. Fifth week, we got a quick correction, a 3-week correction. And then, so I'm not going to count those. So we had 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, 15, 16, 17, 18, 19. So we had 19 months. What am I saying? Weeks. 19 months. Okay. Just draw this out. Gotta get my writing board out. So we had 19 months overall, which is a long time, which is more than 19 months. Okay, that we had a substantial bull rally that lasted 19 months, mind you, and that culminated in the euphoria on January of 2018, where mom and pop actually started to get really involved with the market. The average emotional retail investor right there had a big spike up, and then see you later. We had a very serious correction in the months of February, March. We ran up into October, and then we had huge correction. This is the point where the markets were basically, just ready to crack. I mean, it was rough stuff. We managed to get through it, walked everybody through it, but these were heavy duty. 1,200 points. Remember, 800 points down 2,000, like crazy volatility. There was a lot of stuff going on. Now, so if you have 19 months here, let's start off this substantial rally right here and count. So let's do the month count again. First month. So let's do 1, 2, 3, 4. On the fifth week, we get a pullback. So we're not going to count that. Just the way here, on the fifth week, we got a minor pullback. So 1, 2, 3, 4, 5, 6. I'm still going to count this as an up week because it was a nice hammer reversal. So you got 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12. So we're in the 12th month of this rally. Now, if this goes on for another 7 months, we come into, we basically come into 7 months from now, we come into August. This is on the monthly side. Now, do I think that it is going to be constantly up month after month after month? Personally, from a standpoint of looking at the weekly charts or the daily charts, no, I don't think so. Do I think the year can end substantially higher up here? Yes, I do believe that. But in between, you get corrective moves, what we call technical resets, vol, that's short for volatility, vol periods where it spikes up to 20 because the VIX, which we're going to look at today, and we again look at today because we have to, because it's like skimming the bottom, so it needs a little pop. That's just the way things work. It's as my good friend Mike Harrington always reminds me, it's like a slingshot. I'm sure some of you have used that, and when you're kids, hopefully you don't use that as an adult. But if you have a real slingshot, you got to pull the rubber band back, right? Here's your slingshot. And you have to pull the rubber band back in order to develop kinetic energy which we're going to call KE, that's standard procedure, in order to jettison the projectile, whatever there is as a projectile, towards your target. So markets do the same thing. They move up, then they need to get kinetic energy. They need to basically have substantial corrections, and then just like a slingshot, they move. And this is the major slingshot from the 2018-2019 period that we are basically undergoing right now. All right. Now, saying all that, let's take a realistic look from a standpoint. I mean, not really. Let's take a bullish view of this picture. It's certainly a bullish chart. Now, some people say, "Oh my God, we've been up, 12 months in a row from 2019." Well, I say that we are the bull. Actually, the breakout is where the bull, this current cycle of the bull market started, and that was in the months of, I would say, right here, month of September. So now it becomes a little less elongated. The time frame, like, oh, it's not a 12-month constant rally. Now we're talking about from last September, right there, because all we did during this period is come back, retest this substantial resistance, which was around 29.58. Guys, remember that? We used to say buy the 29.60 calls, and people would be like, "Oh my God, we're so scared," you know. And that fear is kind of diminishing right now. That's a very short term. And I put out some fantastic articles on that so you guys understand the behavioral finance part of the market, okay? A lot of you and a lot of people, a lot of traders out there are starting to get a little bit giddy, And I've seen this happen over and over again. So they're getting a little too euphoric. And some very serious articles came out on the same, using my same words, and I suggest you guys read them. So even though that traders really haven't made any money, honestly, our traders have, but also, most of them out there, they were all like, sitting in the bunkers, with cheap beer and rifles, and thinking that Armageddon's going to arrive. We were like, nope, technically we're on an uptrend. Let's go with it. They're starting to feel comfortable, and so you get these quick short-term pullbacks. And I would certainly enjoy a 400 to 600 point pullback on the market, and that can happen and it'll be quick. It'll be bought, but it's coming. Just letting you know. All right. You can't see that within the framework of a long-term chart, monthly chart, but you can certainly see that in the framework of a daily chart or a 15-minute or 1 hour or something. So saying all that, let's go back to the point I was trying to cover. So basically we tested this 29.60 level or so back in September of 2018. September of 2018. And then we fell. It's just like, and then we started, which was like Armageddon scenario. And you couldn't turn on the TV without like people saying, "That's it, it's all over, it's all recession." Remember that inverted yield curve? Like, oh my God, we're all going into negative rates. And I kept on being positive, bullish. I explained to you guys in many of my videos that the U.S. Central Bank, Federal Reserve and stuff, and the way our economy is set up, we are not going to go into negative rates, okay? Which would be devastating for our banking community. And all the stuff, we had the yields collapsing, inverted yield curve, all that stuff. It was just horrific. There was other stuff happening. That was when we started putting sanctions, tariffs on China. It was the beginning of, a lot of fear. So now all that now, so the breakout really started, in my opinion. We just did a U-loop, took a good solid a year from 2018 to 2019 to break out. So honestly, the breakout is even if we count this, 1, 2, 3, 4, 5 months old. Everyone with me so far? Yes, everyone with me so far?
Yes.
Yes.
Okay, good. And so that's the way I look at it. And when you get these substantial breakouts, this is not mom and pop all of a sudden like entering the market. There's a significant amount of the money that is being put into the market are pension funds, which have finally started to come in. More importantly, corporate buybacks. Think about the shrinking supply of stocks, the number of shares people can buy out there. Think about the buybacks that went into full force 2 years ago. And who were the biggest buyers of the market? The corporations themselves. Look at Apple's buyback, humongous. And all these great companies, just picking one example, they're constantly, okay, buyback, because they found their stocks to be attractive and they bought it back. They bought it back and used it for dividend purposes or for paying down debt, like all kinds of stuff. So bottom line is that once you have that the corporation the corporate buybacks were a significant force on this stage of the rally and even here. Now, saying all that, we're 5 months old on this move, not 12 months, even though it started off here. So just want to be clear about that. Now, another factor that hasn't been talked about a lot, some of you know, has been talked about a little bit. And while I'm doing that, I'm going to go back on the weekly chart. This is your weekly chart. And all these charts were drawn a while ago. All I do is tweak them, update them, and that's it. I can pretty much see that if we have a substantial pullback, where we can go. This is your acceleration channel. It's a beauty. I drew this after the 4th week, a bullish green candle right there, and that was back in October 2019. Because at that point I could from a technical standpoint, I could draw a parallel channel, and this is what I call not the first time, a acceleration channel. All right, and that acceleration channel, upper Bollinger of that is 3354. So we're like knocking on the door of that. That's roughly about another 24 points from here, roughly another 150 Dow points or so, which we could get this week, for all you know. Because I know for a fact they're going to end January on a strong note. I think so. And then February, they're going to slap the market a bit before they pick it up. Because February also has a lot of emotional baggage for people, because back in 2018, in February, the markets dropped more than 2,600 points, the Dow Jones. You guys remember that? Okay. So February could be tricky. And then let's see, one step at a time. So bottom line is, that the other thing which has been pushing the markets substantially higher, because it started, I don't have the exact date, but it started last year. No, this year. No, last year. I mean, in 2019. Can somebody tell me what the Federal Reserve did in the past 6 months?
Lower interest rates?
Not just that.
Quantitative easing, but they didn't call it that.
They did what?
Quantitative easing, but they didn't call it that.
Right. It's called the repo purchase program. Thanks for answering that. So basically, Oscar's right. So basically, we are doing quantitative easing every day. I mean, I get obviously these notifications. We are doing, if I'm right, like 20 million here, 30. We're doing almost $60 billion. Okay, of repo purchases. Okay, and please read up on it. Basically, the Fed goes in there and stabilizes here. I'm going to give you the definition directly off Google. Okay, the repo market, read up on it if you want to learn a little bit, is known as a repo, or a sale and repurchase agreement in the form of short-term borrowing, mainly in government securities. The dealer sells the underlying security to investors and buys them back shortly afterwards, usually the following day at a higher price. So what the Federal Reserve is doing, and as Oscar correctly pointed out, they're doing full-scale quantitative easing, where they are pushing liquidity into the U.S. economy, creating lots of liquidity in the repo market, which primary dealers operate in. And they're doing that by buying mortgage-backed securities. They're doing that by buying corporate bonds, things like that. All right? So it's very simple. Just look at it in a simple way, because I like to take these more complex economic concepts, make it simple. Everyone remembers quantitative easing. Okay, when QE started, there was so much criticism, it wasn't even funny. They wanted to put Bernanke on the stake. But what did QE do? It reinvigorated and powered the U.S. economy from the midst of a devastating recession back in 2008, 2009. It was the lifeblood. It was the B12 engine. It was the, what do you call it? It was the, what's the word I'm looking for? The IV that you need after a traumatic accident to stabilize the U.S. economy, and the quantitative easing continued. And I have so many videos on that, when covering it. And they said, oh, when quantitative easing stops, the markets are going to drop. Yes, it did drop for about a month or 2 months. But after that, the quantitative easing moved on to Europe, They started doing it, and then boom. Now, quantitative easing, QE, or this repo purchase program that is initiated, and the Federal Reserve Open Market Committee goes in and buys securities from primary dealers, primarily Wall Street investment banks, large ones, pushes money, injects money into the system, and that money flows into equity markets and other financial assets. Okay? So they're doing that, and they're doing that to stabilize the overall repo market, because back in October, when things got really a little bit choppy, and the markets in July it happened, and then it happened again in September and October. In September, there was there was a lack of liquidity in the repo market, and that was causing some serious, dislocations. Fancy word for market drops, because there wasn't enough liquidity in the market. So anyway, read up on it. So yes, we are doing a form of quantitative easing, and quantitative easing the markets always love. Now that quantitative easing, I believe, is going to stop in the month of February and March. Right, pretty much when I'm telling you the markets are going to drop a bit, because there's going to be less juice to play with. If you were a hedge fund and you could go out there and borrow 10 million bucks at like nothing of an interest rate on the overnight repo market, right? Maybe 1%, or I don't know, something like ridiculously low. And then trade that next day and trade the crap out of Netflix and Tesla and, all those big companies. Why wouldn't you should do that? And that's what they do. And when the hedge funds borrow this stuff, they get huge margin. I mean, it's like almost 10 to 1 leverage, if not more. So for every dollar, they're buying 10. I mean, they can borrow $10. On our margin accounts, under the SEC guidelines, it's 4 to 1, right? So if you have 25,000, it's a day trading account, you get $100,000 worth of buying power. Even though options always have to be paid in cash, as you all know, you can buy options and margin. And that's a good thing.
Hey, Frank,
Imagine,
can I ask you a question?
Make it quick, because it's not
Okay.
Q&A session yet. But go ahead.
Okay, thanks. Just on that subject, obviously the Federal Reserve's meeting at the end of January. At some point, they have to, signal some kind of pullback on this repo money. Do you get the sense, with what you know now, do you get the sense that suggestion might come now, or would it wait till later?
It's a damn good comment, guys. Everyone give high five here to Oscar. He obviously knows the interest rate market well. I think the Fed, even if they mention that they're looking to scale it down, the markets are going to drop like 800 points, bam, just like that. Yes, I do believe they cannot. I mean, again, what do I know? I'm just like another idiot, clueless trader. But the Fed can't endlessly keep on with this QE. You know what I'm saying? So they, as far as signaling, whether it's a Fed governor signaling or in a speech, Fed governors go out a lot right before meetings, and they said there's another meeting at the end of January coming up. So they start hinting, and some of them have started hinting that they're starting to worry a little bit, because you can't, every time that the Fed they're going in and stepping into the open market to buy securities, they're basically just liquefying and pushing in so much money into the market, which becomes dangerous. Our budget deficit, I think, crossed over $1 trillion. I'm sorry, our debt. Our debt is already trillions. I'm talking the budget deficit. It's like crazy. I mean, remember the time Obama and these guys were doing that? They were like, these guys are all freaking socialists. They just want to balloon the U.S. debt. They don't care. Well, what happened since then? We did it more. But the reason the U.S. economy doesn't flip over, for reasons I explained to you, is because we're basically printing our own money. And I've always said that. And the other reason is that President Trump coming in and this extremely business-friendly initiatives that he took, okay, great stuff that he did, there's more tax revenues coming in from corporations, because there's a lot more people making, a lot of companies making more money, and they're paying into the government coffers. But yes, in answer to your question, I believe the Fed will make some sort of comment, and that will set the stage for a pretty nice little pullback. Substantial. I mean, a strong pullback. It could be. And if Bernanke goes out and says, nope, we're stopping it in February, and he actually puts a date out there, February or March, trust me, Donald is going to start tweeting like mad, and the markets are going to drop. So yes, that's the answer to your question. So I believe it. I believe they should, and I believe it's responsible for them to do that, and because they can't keep on pumping the U.S. economy with printed money. It's not really printed money, but still, it's more of an accounting function forever. All right, so let's looking at the daily market, this being the futures market. You can clearly see here we're in a very strong bull uptrend, hugging the upper end of the blue line, which is the Bollinger. Very easy to see, and we are reaching again. How far can it go? Look, bull markets can go a lot further higher, just the way bear markets, short-term bear markets that we incurred, can go a lot lower than what we think they can. But so we have certain measures, and one of the easiest measures that I've told you guys to really watch out for. This is the reason why I'm buying the hedges. VIX calls, UVXY. I was up on the UVXY very nicely. My cost basis was like $1.40, close to $2. Lovely, So I already got more than I got almost 80%. Left it there. I'm going to keep buying it, and I'm going to talk about that trade because that's one of the easiest trades you can do right now. Instead of scratching your head and trying to figure out if Netflix is going to be up, 30 or down 30 on earnings. I'm telling you, sometimes just look the easy way out. So one of the simplest ways to look at it is the distance traveled, the standard deviation from the major moving averages, which are the major highways. So you can clearly see here very clearly that at this point the standard deviation is pretty substantial. Offhand, I would say that's a +5 or a +6, and that's stretched by all metrics. So short term, the market has to pull back for bulls like us, so that the bull market can live. Otherwise, it's going to be bad, because technically you can't get this overbought without any type of quick pullback. And these pullbacks will be very quick, by the way, very fast. Because so every single time that the markets have stretched out that far, you have had, and this is the daily chart, you have 1 to 2 days or 3 days of a quick pullback. That's what I'm expecting, just the way here. And these are the ones I told you guys, buy, and showed you all the beautiful charts and everything to buy. Some of you did, some of you didn't. Look at that, 3 days of bang, bang, bang. Everyone's like, oh my God, here it's coming again, incoming. So we need one of these just to reset. So the reset doesn't have to be to all the way, because to 3,200, which would be a lot. That means a drop of almost 1,600 points on the Dow Jones Industrial Average. The bears will be like, that's it, we told you so. And it just needs to, what I think would be healthy is the uptrend lines continue. And as you can clearly see, we just need to test the mid Bollinger. What's the mid Bollinger? This line. You can see this all on your charts too, around 32.62. So if we drop to 32.62, you can see that number here, right there. So if we drop to the mid Bollinger, and it slips normally, because by this time panic sets in so hard that you get these slippages, and those slippages get bought. Look at that. This one bumped off very beautifully. Hammer reversal on the daily and we're buying on the 8th of January, right? So you get this is the panic stage. This is like, oh my God, all the stops get triggered. Day traders are like fleeing because they're, proprietary trading firms which allow day traders. You have those proprietary trading firms where you can go and they give you money to trade with, but you got to give them a cut and stuff like that. They're like, that's it, you can't hold anything overnight. The margin clerks come in, so you get that slippage, and then the smart money comes in and starts buying. The smart algo money, if you want to put it this way. So first level of contact would be 32.60. The 34-day moving average, which served as a major support on the 8th, is at 32.28. So let's do the quick math here. 32.62. We closed at 33.30. So you got 32.60. That's 68 points. Let's call it 70. So just from here to here, where we are right now, We're at 33.27 on the E-minis right now on the live market, on the Globex market. So let's say 68 points. 32.62 minus 33.27. I'm doing it backwards. It's 65 points. So 65 points. I always use a wide factor of 8 to try convert it into how much the Dow can drop in, because that's going to be the headline number everyone's going to be talking about. Us traders look at the S&Ps and the minis and stuff. That's 520 points. I'll take that any day. You're going to get 300%, if not 400% on the VIX calls. Boom, just like that or more. And what is sweet trade? And it's going to be quick. But this is a very strong momentum, upward momentum market. So they're not going to let it go that easy. And they want to burn like more shorts, more of these short funds. So yeah, 520 points. And if we drop to 32.30, that's 33.28 minus. Everyone with me so far? This is called predictive analytics. And every time I've done this, I've been right 80% of the time, if not more. So please focus. So 98 points, if we drop from here, and nothing happens in a straight line. If it happens in a straight line, the better. You know what my term is. The faster and the more furious and the more ugly the pullback is, and you're on the right side of the train, the better off it is, because the washout happens quickly. I hate this drip, 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 drip trade, and then they drop it. Like, come on, give me that 700-point drop immediately. All right, to flush out everybody. And that's what I like. Fast and furious. Equal and opposite reaction. Bang, get this, you're going to get this. Newton's law of motion, right? Every action has an equal and opposite reaction. So the slingshot effect. This is the ones which get tricky. Bang, goes up. We played this. By now, throw anything at me. My charting is good enough to predict, or not just predict, but at least walk people through thing. This is the one that just drives people nuts. Keeps on going on for a full month, and then breaks out, and then comes back down again. It's like, oh my God. You know, it's happening again. Relax. Every time you get this oversold, you want to buy hands down. And every time it went and dipped and retested the same levels, the stochastics created a higher high. That's known as a positive. What's that? Come on, one of you at least know the answer. I purposely didn't spell out the full terms. And I've shown this on my charts. I've written it down. So let's see who focuses. When you make a higher, when you get to the same bottom, you're retesting the same bottom, yet the internals are creating higher lows and trending higher. What is that term called?
Positive divergence.
Thank you very much. So please, next time, it's a great answer. Next time, quicker, because you just wasted 4 minutes of my time. I'm just kidding. Who was that? Z?
Yeah.
Exactly. And a positive divergence are one of the best ways to make money on the swing trades, both in the markets and individual stocks. Positive divergence always play out within days. They don't happen instantaneously. Sometimes you could start seeing, and the same thing with negative divergences. Okay, the market could be trending higher, and I showed you a negative divergence on the S&P 500 just on the last webinar, and it could continue to go higher while the internals start to weaken, and that's a negative divergence, and then boom, it goes. So it doesn't have to be like, it's not instantaneous. It's a bit of a lagging indicator or a leading indicator, whichever the case may be. So in this case, it kept on doing that. It was a leading indicator telling us, no, the market wants to break out, even though it kept on creating this very complex W and driving everybody in deeper and deeper into the canyons with cheap beer, right? And bad guns? Just kidding. So that's what happens. Same thing. Positive divergences. Okay. So at this point, there is nothing here to show that, yeah, we are supposed to come in for a landing. Oh, there's the other line that this is my channel, right? That I've drawn. So where is that? That's at 3,300, roughly 3,300 or 3,290. That'll be the first move down, just to retest the breakout, the significant breakout over the upper channel, this one right there. So if we drop here, we got 3296. That's how many points? That's 32 points, right? 32, 28, and 3296. Let's call it 3300. So 3300, and we are at 3328. So 28 times 8 to be exact. We are looking at 224 points. That's going to be the first quick retest. If it falls below, then of course this comes into play, which I just explained to you guys. Am I clear on this with everybody? So a
Yes.
quick 200-point drop in the market should be welcomed, and it alleviates some severe overbought conditions on the short term. On the daily, if you look at the trajectory and the directional bias of the full stochastic, they're still moving strong, moving sideways. Just the way the markets move sideways in 2019 for days and days and days. So it's still moving sideways. So the markets are still strong, no question about it. But we're getting stretched, and the stretch, the simplest way to look at the stretch is how far you are from your 50, 30, 40-day moving averages. There are other metrics which I put out there, by the way. Read those articles I put out. It takes 5 minutes to read it. And they show you some valuation measures which are way out there, even though I don't agree with some of them, but who am I? You know what I'm saying? I'm just telling you. So now we come into the nitty-gritty of what can happen now as the markets open on Tuesday. So let's take a look at it. I constructed this chart at a very important a business meeting. That's why I couldn't be at the party with you guys. But I was doing some nice trades off the bat off my phone. Whenever I got a chance. I was stuck there. I was supposed to be back at 2 p.m. but I couldn't make it. And it was a great day. I was taking some nice profits on things. I was just actively trading, but I left my Karuna Therapeutics. Told you guys to buy it. This thing's at like 106. Where's it going? 200? Yeah, most probably. There's no. I shouldn't say there's no options. I saw options like, wow, look at those options. I bought those options around $5. They went to 10. They went to 11. The spread right now is 8 to 11. I know Oscar will have a question on the. Would you sell the VIX calls? Oscar, I just told you that I expect the VIX to go higher, but so no, I didn't sell the VIX calls. I'm going to buy more VIX calls. No, I didn't. If somebody's up, let me finish. 80% on them, sure they can sell it. I wasn't at my desk, but more importantly, I wouldn't sell it. That's my opinion. But hey, 80% is 80%, and I got a nice amount. All right, so certainly. So a new member asking me, would you sell the VIX calls? My answer is, don't ever ask me questions like that. No, I'm just kidding. Seriously, let's take a look at the VIX chart after this, and you decide what you want to do. So, because it's a natural tendency of traders to ask the supposed guru of the markets, which I certainly am not. In this case, Clueless Say Trading Frank, i.e., me, like exact, specific, loaded questions like, should I sell here? I don't know. I don't know how much you're trading with. I'm showing you the charts. I'm telling you where it can go. I'm telling you the market's a severe overbought, that I expect a 200 to 400 point drop within a short period, and then the markets bounce. So why the hell should I sell the VIX calls? Did you understand what I just said? So you got to read in between that. But loaded questions like that, I'm sorry, I walk away from that because hey, I can't help people with that. So So here is where we are on the 15-minute, and it's a damn good looking chart. I mean, really, it is. So if we break out over 33.30, forget valuation. The market is going to try to jettison up towards 33.45. Look how symmetrical, how geometrically perfect these lines are. These lines weren't just drawn out of a, whimsical idea like, okay, let's just play around and draw some parallel lines. No, each of them have a major inflection point that I tried to touch, that I tried to connect, I should say. And each of them are pointing to 33.47, 33.42, in between a trading box, which I repeatedly said is between 33.16. This chart, you guys should either replicate, screenshot, do whatever, because this is the chart you should be trading off, both on the indices, if you're playing the SPY calls or puts, but more importantly, to get an overall feeling what the markets are going to be doing. This is almost a geometrically picture perfect predictive trading chart. Just want to be clear on that, period. All right? I personally, when I draw these charts, it amazes me sometimes when they're just so asymmetric. They are so mathematically, visually appealing to me that I'm like, good, I have a handle on the market. Are you guys with me on what I just said?
Yes.
Good. I want to hear a real yes from other people too. Don't sleep on this stuff, guys. Because when the whopper hits, when the whopper goes higher, you're sitting there going, what is the market doing? Well, frigging, I'm explaining it, what the market's doing before it's doing it. So please. All right. I don't want like this is not a Marine Academy drill or a or an Oprah Winfrey show. Everyone has to say, yeah. But I'm just saying, give me a resounding yes or no. And if you don't understand, I'll explain it. So saying all that, this is your range, 30 points roughly. On the extreme case, 30 points. 30 times 8 is 250 Dow points. This is your range. This is the initial range. That's roughly 14 points. 14 times 8 is about 150 points. Right? Yeah, I'm just basically looking at some round numbers, ladies and gentlemen. It says 112 points. Let's call it 120 points. That's between here and here. See how the algo's kicked in right there? So this is roughly 120 points. If you do a equal distance here, that is roughly another, this is 3330, where we hit at 145 on the 17th, which is Friday. So what's the depth of this channel? The depth of this channel is 14 points, right? Everyone with me so far? So 14 points, so add 14 to this, we arrive at pretty much right here. 14 plus 30 is 44. So somewhere here. See how, because you look at the width, and if we get a serious range breakout, then it'll be a measured move towards, add 14 points based on the 14-point width. Everyone with me so far? It's real simple stuff, but it works. All right. Is everyone with me so far?
Yes.
Okay, good, great. And then if we slip that, I know where we can fall to. Each of these points are very defined, and this is basically since the 15th. So basically it was since last week. So I'm looking at things I'm keeping close. And if you notice, like this is pretty much where the acceleration started, the short-term acceleration. So the 15th, ladies and gentlemen, was last Wednesday. So this is what the markets did since last Wednesday. So I'm going to use that as a pivotal point to measure the short-term moves on the market. That's the way I'm doing it. And believe me, these can be extremely profitable. You see a big breakdown, whatever, you can quickly jump into a couple of puts, whatever, a breakout, you can buy some calls, or you can set yourself up here. I am looking at it from a range standpoint. It comes down here and we started to get this reversal candles. Sure, at that point you can buy a couple of SPY calls and then take down your VIX stuff. So that's pretty much it. So definitely screenshot this stuff. There are enough free screenshot programs that are used. The one that I use extensively to post all my trades, alerts and all that stuff is Snagit, TechSmith. Snagit is his name, Snag it, one word. You can pay a little bit for it, or it's free. Get that. Screenshot this chart. I don't want to repeat it again. This is a similar chart that I kept on showing you guys, and that projects out again to 33.44. So, as I like to say, max upside for this coming week, in my opinion, could be this. Max downside would be around the 3,300 level. It's really as simple as that. So we have a very defined pattern. Now, let's take a good look at the VIX. Now, whichever way you slice it or dice it, the VIX is, from a swing perspective, is a screaming buy. Well, what's going to happen? The VIX is going to crash below 11? Yeah, sure, anything can happen. But the way I'm looking at it, and I'm going to draw some broad strokes, what does this pattern remind me of? And by now, you guys should know this.
Falling wedge.
Exactly. Thank you for the answer. It's a falling wedge. There are many multiple falling wedges, small ones that took a couple of days and boom, then they went. All right. So I'm looking from the VIX standpoint. That's why I bought the 12 calls, and I have so much time left. March, right? And then I bought some cheap ones for next Wednesday. But the real bulky positions are the ones for March, right? That's the ones I bought, and I bought the March 15s. March 15s, because when the VIX moves, it moves in increments of $2 to $3 on a heavy pullback day. So from a chart standpoint, this is just concentrate on this. I'm just going to zoom in. So this is your picture of the VIX going back, ladies and gentlemen, to what's the data here? To beginning of the year, January of 2019, not 2020. So let's do this, ladies and gentlemen. Okay, so is this yellow? No, always keeps on changing on me. All right, falling wedge, quick bump. The VIX even goes to 13, you're going to double your money. This is your sideways moving 34 and 50-day moving average. If it busts a move and hits this macro downtrend line going back from July of 2019, ladies and gentlemen, that's at 16, around there. Those are major resistances to cover. The VIX has faltered lately all around the 13 level, but it's creating if you notice, the VIX these days, sometimes with the markets up, the VIX stays flat. And you've been hearing that on the media too, like, you know, because there are many different ways you can protect your portfolio. Insurance doesn't just have to be VIX. There's so many other ETFs which are short the market, this and that. So the VIX doesn't have that much leverage anymore, but at least I read the charts, and it certainly has worked out great for us, as you know, in predicting move. Falling wedge, predicting a corrective move in the market. Falling wedge, then it moves sideways for a couple of days, and then bang. Big falling wedge. Yep. All right. So that's pretty much it. Now, in the meantime, markets could be, markets are up and the VIX falls to 11. Great. I'll buy a few more because I have so much time left. And then you have the Fed meeting. Then you have some comments like Oscar very smartly pointed out, and I explained on Chairman Powell might make some comments on this quantitative easing / repo purchase format, systematic buying that they're doing every day. And what? Market won't be down one day, in between now and March. I mean, come on. So that's why I'm saying this is a cheap trade. And I love the calls. They're so cheap. So saying all that, that's the VIX. Now let's take a look at the VIX on the 1 hour. The 1 hour VIX is getting is something that you can look at it more closely, I guess. So what we got here? What do we have here? Well, falling wedge, a breakout, 13, 14. I'm not asking for like those hardcore dogmatic bears keepers. Oh, the VIX is gonna go to 20. Sure it can. If you know how the VIX can go to 20? Can somebody, you guys are very smart people, think about what can happen to the market aside from the Fed factor that I just mentioned? What else can happen to the market which can just shoot the VIX up to 20 and the market will be down like 800 points? Everyone's just going to be like, oh my God, this is scary.
Could
What
be
can
something like Iran or Europe.
I'm sorry, what?
It could be something to do with Iran again, some type of missile attack, unexpected news, or even
Well, we saw what happened with the Iran attack. There was no violent attack. Yeah, that's one factor. I don't consider that
Europe,
to be a major factor. But even though if we get into a full-scale war with Iran and we bomb their nuclear facilities and they go nuts, then yes, that's a good reason. But I'm thinking of something else.
trade war with Europe, maybe, or
that's another reason, and that's, by the way, it's starting to boil up. But that's not but these are all good reasons. And somebody else maybe give me a couple of answers. Impeachment? Impeachment is a friggin' joke. The markets will fall for 2 days and then rally like a monster. What's going to happen with impeachment? They're going to impeach him, and what? All of a sudden, all the great policies, business policies and stuff that President Trump put in place are all going to disappear? No. And if they impeach him, and let's say Vice President Pence, let's say extreme scenario, takes over the presidency, the markets are going to cheer. The markets are very selfish beasts. They don't care about individual people, like I explained. They don't give a hoot about Clinton, Obama, as long as they're not changing the system. Exactly, right? And so, yeah, no, that's that. Yeah, short term, yes, it's definitely going to cause the market to drop. Thing, but something which will break the market on a multi-week basis. You guys can think of anything? Okay, let me answer the question because can you mute your microphone? I know you. Yeah, that your kid, Z?
I'm actually muted. My kids are asleep.
No, whose kids were there in the back that I heard?
I have no clue. Maybe
Oh,
Oscar's.
whoever's kid was. See, kids get excited
You
listening
can
to my
hear the
voice.
bird from me, though. I have a bird, but kids
No,
are.
somebody else. I heard kids. I'm sure a bird doesn't sound like a child. But see, the kid was excited, and maybe they were looking at these charts and saying, "Daddy, look at those colors. I want to draw those things." And he'd probably be a better chartist than I am. So this is, you see, I'm an outlier thinker. I like to think outside the box. What if we wake up one morning and a tweet comes out of President Trump that he's really starting to get pissed off with the Chinese because they're not keeping up with their end of the bargain? What do you think's going to happen to the market? See, and that can happen. Phase one trade deal is done. Fantastic. I was the biggest cheerleader for that. And nobody expected it. Hey, all kinds of garbage. I said, no, he's going to make it happen. But let's say a month from now, he says some sort of snide remark. The Chinese are, starting to slip a little bit and he doesn't like it, but I'm sure it's going to keep. Markets are going to drop. Boom. Get it? Got it now. All right? So I'm telling you, and that's a possibility. Because just like here, some people are not happy with the deal. It's even some hardcore Republicans, and forget the Democrats, they're like more hard on the Chinese for what reason? I don't get it. At least President Trump, beat them up, and then they kind of retaliated back, but the deal was done. But what if there are people in China too, in senior levels of government, who don't like the fact that that they haven't removed the tariffs yet? So look at that side. So that could happen. So there's a lot of factors. The other factor is, and by the way, I wasn't picking on the kid. I wanted to congratulate the child, whoever voice I heard in the back saying they're excited. So everyone's like, oh my God, I mute the kids. I'm like, please don't. Let the kids scream in the back. I love it. So that's what we do this for, right? Well, one of the reasons we do this for. So bottom line is that, yes, the other factor is earnings. We're getting into the thick of earnings season. And there's going to be a lot of companies coming out. And what if the overall guidance is not necessarily good? Which I don't believe so. I think earnings, I think they're overall going to be more optimistic because the China trade deal got done. A lot of companies which sell heavily into China because it's one of our biggest markets for some companies, Nike and stuff included. So I think they're going to say good things. It's going to remove some of the overhang. But what if they say, no, they're still worried because tariffs have been lifted and this and that? That's another thing. The market has to grow into the valuation that we have, the standard metrics that the average analyst uses. If earnings not necessarily disappoint, but the guidance disappoints a little bit, the markets are going to not like it one bit. So that's basically it. Now, Q&A. Throw it out, guys. If you guys, 1 second here. Did I need to show any charts? Oh yeah, let me show my proprietary charts. First of all is this one. All right. What is this showing? I told you guys that if you started to see the stochastics, I think it was the one before the last, starting to turn, you don't want to be heavily short the market or anything. Well, that's exactly what it's doing. Once it gets into the overbought level, it always resets. This is the New York Stock Exchange McClellan oscillator known as NYMO. Here we have a small pullback. You can see that. Just use visual. Don't worry about the numbers. And it's sitting at the mid Bollinger. If we pull back towards 5, the market will basically, and this is updated for me at the end of the day. It's not real time. It's basically if it pulls back towards, let's say 5 or there, the pivot lines, then that means the market's going to be down 150 to 200. And if it just goes like this, that means the market is going to be down 600 to 800 points. Okay? And that'll be another major buying opportunity. So short term, it's still telling you, yep, we're good to go. We could have some gyrations during the day, but we're still good to go. So there's no danger sign here. Next one is your weekly McClellan oscillator. The weekly oscillator is actually pretty bullish. The weekly oscillator does not get really euphorically, technically, and mentally overbought till about 40s. We're far from that. We're only at 17.68. This is starting to buckle down, which is not necessarily good. So short term, there's danger. Because you see how this is the full stochastics. The full stochastics, percentage K and percentage D lines are starting to buckle down. So that means a quick correction is coming. Every time it's done the same thing. Let's take a look at the SPX 533, another proprietary chart that is done on real time. I don't trade off this, but it gives me a beautiful idea about what the directional bias of the market is looking strong, strong, strong. This is your daily. Just look at the directional bias. Still moving sideways. Nice breakout. And the MACD histograms were back in December. I told you guys, when the MACD histogram start to shrink, you want to buy overall stay long because they always go nicely positive. Not maybe for that many days, but at least a couple of days. So at this point, we had a slight negative. That's when we had this kind of a mini correction. 1 day, look rough, and then now it's accelerating. However, it's approaching those levels which are considered to be extreme overbought. But this can reset during the day too. Generally speaking, it doesn't always have to reset, just like the RSI or relative strength index below 30. You know that old saying, buy below 20 and sell above 80? Well, this is the second derivative of that, the stochastics. So bottom line is it can come down, retest 70, bounce off there, retest 50. It's done that a few times. Whichever the case, still looks okay. Let's take a look at the weekly. And the weekly is just like a fire, technically speaking. Let me go back a few months. Let me go back 6 months. Landscape, overlays, Bollinger, simple moving average, pivot. Put some color on it. Beauty. So let's look to see what it's done. Let me go back 1 year, 0 months and 19 days, just to try to capture this line here. So if you notice, this is one of the longest stretches we're having. What I explained at the onset of this session, the number of weeks, right? And this has a slightly different algorithmic bar right here, algorithmic candles, right? So that's why they don't show that many reds. But so yeah, so you can see what's going on. Nothing here on the weekly is showing of any major catastrophic downturn. We could end 3455, even 3500, even 3500 on the S&P 500. So I don't see any real technical damage. Okay, guys, opening up just give me a minute. You guys sort out your questions.